All right, this is going to be a trade recap for 3/12/2023. It's going to be our Tuesday CPI, and so some of the concepts that you need to know are your market maker models, your protraction profiles, your basic ICT concepts, standard deviations, and your ERL to IRL. And for all of these things, my mentor Fees has great videos on them. I'm going to link his YouTube channel below. Definitely check those out. So let's get into it. But the first thing I want to show you is my entries to show you that I actually know what I'm talking about because transparency is important. You can see here on the left or the right side here, this is a live account, this is a PA account, this is a funded account. And I did have an accidental order entry here. Was doing some other work and I had it there for longs, but you can see I had a buy here and then I immediately closed it, right? 1375 and 12. And then these are my entries. Had two contracts at 35, kind of closed one at 92, one at 305. And then I had another short right here at 96 and 09, and I closed them both around like 60. So those were my entries for the day for sake of transparency, just so you guys can see what I know what I'm doing. Let's get into it. So in terms of how the market books, right, we move from internal range liquidity, so that's our fair value gaps, our breakers, our order blocks, but for sake of simplicity, I'm going to target order blocks and fair value gaps because that's what we can see on the weekly, and then we target our ERL, which are our swing highs. In terms of the weekly structure here, you can see that we did hit this internal range liquidity, which was this order block here last week on March 4th. And so in terms of just simple ERL to IRL, we should be targeting this ERL here. Okay, so let's drop down to our daily time frame. Right? And so it's very easy seeing this sort of consolidation up, right? You can consider this bearish consolidation. It's very easy to want to just try and short this down, especially to our IPDA day lows. And I'm going to pull those up right now. It's very easy to want to target these IPDA 20-day lows. They are very juicy. And but it's important to know our daily structure. It's important to know our higher time frame SMTs on the 4-hour, on the hourly, or sorry, the 4-hour and the daily. And so without those, we can't really qualify any sort of SMR or anticipate any sort of daily market structure shift without having that higher time frame confluence. So you can see here on the daily, a very obvious draw if you were bearish for today, considering market structure. And I want to pull up this daily and this daily. And, maybe potentially you could have said that, ES traded a lot higher. That's an SMT. But for sake of just, and really what it is our SMTs is a higher high, and the other one makes a lower high. So you can see that doesn't really happen. So in terms of price booking and ERL to IRL, we should be trading higher. And so let's get into and we can draw our internal range liquidity. And like I said before, we're going to be doing order blocks, OB plus actually. Right, so that's our daily order block. And then we are targeting this external range liquidity for the week. That's our weekly objective at 690. And so I'll just put that as our buy side. All right, cool. Let's drop down to our hourly and let's see what's going on. All right, so we know that we're moving from IRL to ERL, and we have been trading down. And so in order to qualify to find our market maker model for the week or for today, we have to find an SMT. And if you watched the last video, you know that SMTs qualify our SMRs. So let's go to the hourly on NQ and let's go to the hourly on ES. And I do want to note, and it's going to be a little bit, it is not a little bit, it is important later in the video to note that YM can also be used for cracks and correlation for our SMTs. And you're going to see an example of that at my first entry today after CPI data drops. So let's draw our SMT here. You can see this 3 a.m. low on NQ and the 10 a.m. low on NQ. You can see that NQ puts in a lower low, but ES does not. Right? And that's our SMT. That qualifies our smart money reversal. And another thing I do want to consider is the 4-hour SISD. And a lot of people have trouble. They say, how do I validate my intraday bias, right? How do I know which way are we going to trade, right? Because we could be bearish on the higher time frame. You could say, okay, we know we're at all-time highs. We just took external range liquidity. I want to trade to the IPTA 20-day lows that I showed you before, right? One of the things that's going to help you validate your intraday bias, and I use this all the time, is a 4-hour SysD, right? The 4-hour activation of an order block. And you can see right here at this opening price, we trade through it. And all things considered, on the 4-hour, if we're moving from ERL, which we take here at 10 a.m., our IRL draw is here. It is this, and I'm going to draw it out here, right? So this H4, H4, right? So this is our internal range liquidity that we'd be targeting after we get this 4-hour SysD, right? And the main bread and butter is going to be, sorry about that, and the main bread and butter is going to be on our hourly and the M5. And if you are just starting, I highly recommend that you use those time frames. Those are the time frames that I learned on before I started jumping around to the 1 minute to get earlier entries and that kind of stuff. But let's draw our market structure shift. And so I don't want to get too much, I don't want to deviate too much from what I'm talking about here, but there's a longer intermediate term market structure shift here as well. And that's our long term. I'd say this is our intermediate kind of shift. This could be intermediate or long term. This is your intermediate term shift. And then this kind of here is your short term market structure shift. So I'll draw all these out. And if you're confused on what I'm talking about on the short term, the intermediate, and the long term, Afiz has a great video on advanced swing structure. And if you're having trouble recognizing your market structure shifts, if you're having trouble kind of painting candles, knowing which candles are proper swing highs, which ones are actual swing lows, go watch that video. It'll help you out a lot. You're really going to know what you're doing and actually how to read candles, how to paint candles, especially when they're in real time. So we have our 1-hour market shift. And I'm going to focus on this intermediate time frame one, because if you know, those are more important. And after our 1-hour market shift, we do have this H1 BISI here. All right. And now let's talk a little bit about our protraction profiles. It's going to pop up right now. If you know your protraction profiles, right? Someone could say, okay, you know what, man, I see that London has classic bearish protraction above MOP. I'm bearish on the day, right? But at the same time, you need to consider narrative. What is our narrative? We had our 4-hour SysD. So when you combine your narrative with your protraction, doesn't this accumulation below MOP make a lot more sense for a bullish day, right? It's very easy to look at individual concepts. It's very easy to look at an individual market structure shift. There's some sort of displacement downward and say, I'm bearish, right? You have to consider all the confluences together, right? Because that is what forms your narrative, right? That's what gives your trade narrative. So the true protraction here was late London and delayed London, or late London, which gives you continuation off a fair value gap. What is this? This is our hourly BISI. Late London protraction, below MOP, continuation off of an hourly BISI. So you can kind of see how the concepts are starting to blend together here. And I do want to note here on the 15-minute, look at these wicks, right? These continuous wicks, and even the CPI wick, right? You can forget the CPI. Let's include the CPI wick for now. And I don't really have a template for this, but I'm just going to do, actually I do. No, not an RDFB, rejection block. Where is it? I know I have one. All right, I probably don't. All right, so this is our rejection block. You can see how, look at all these buy wicks here, right? That means something. That's institutional, right? Smart money is not allowing the body closure, right? You can clearly see how the bodies are respecting any of these wicks. There's no sort of market structure shift below them, right? And so we can drop down to the 5, right? If you are a gambling man, if you are a betting man and you like to gamble, right? And people say 99% of gamblers quit before they make it big. I'm going to tell you right now how to make it big, right? Don't gamble though. um, if I was bullish on the day, and I am, 4-hour SSD, hourly market structure shift, delayed protraction for London, I would want to see a sweep of all of these stops. I would want a sweep of all of these stops that we've induced. This is inducement. The lows touching right above the BISI. One time, two, three, four, five, even at 8:25 before CPI came. I would want to see this low get absolutely ripped, because the sweeping of these lows is order pairing. It is institutional order pairing to go long. Let's see if we can draw from MOP. Right? And so the reason why I chose this standard deviation leg in specific, and if you don't know how to choose your standard deviation legs, one tip I will give you is the highest quality standard deviation legs are going to be the legs that manipulate on NQ to be an SMT on either NQ or ES that trigger our SMRs. Drawing your standard deviations from those legs are always going to be higher probability, and standard deviations are algorithmic. You can't fade them, right? And I'm going to show you right now here. This is a clear sign of it too. This is a clear sign of manipulation. Just green candles straight up, just straight up candles, right? There's no sort of retracements, no sort of recumulation, just straight up. Look at this. At the negative 2.5 level is exactly where the CPI candle reaches before exploding up, right? But here's the thing. If we're bullish on the day, and if we sweep those lows, ideally you'd want to see an SMT be put in place. And that is exactly what we get. We get another SMT. If you look at this 3 p.m. low and this 8 a.m. low, this 3 p.m. low, 3 a.m. low, and this 10 a.m. low. Where is it? Right here. I'm fading some sort of structure. Here it is, sorry. This 3 p.m. low and this 8 a.m. low. ES puts in a lower low than NAS does, signaling that this is our SMT level, right? The fact that this low on NAS held tells us that this candle, after sweeping these stops that we induced above this hourly fair value gap, this is a high probability that this CPI candle on the 5-minute is going to wick. So let's go back. You're a gambler. 99% of you guys are going to quit, but only 1% will make it. Don't gamble. But what I'm trying to say here is that if you had to gamble on CPI, you would place shorts down, expecting the SMT, covering it, and then getting long. That is stupid. Don't do that. Don't do that. But I'm just saying, that's what I thought. That's how I tape read it, but I didn't play it. You saw my entries. And now let's go to the hourly. Right? One of the things to note is that data highs or data news highs and lows are going to be targets of liquidity. Those are always sweeps that you're going to see happen. They're highly draws on liquidity. If you don't believe me, go back in time, look at your CPI candles, look at your NFP candles, and more like really look at your CPI candles. Those highs and those lows are going to be targeted all the time, right? So let's go to our 4-hour now, right? I want to look at this low here, this swing high here at 2 p.m. Right? You can see that ES sweeps that high right here at this candle here. ES sweeps that high while NASDAQ does not, right? And NASDAQ also has an H4 SIBI, right? So the first time that I played shorts was on the 1-minute because I saw this SMT, right? And so you're saying, okay, you said Yusuf, you just said that SMTs qualify SMRs. You had an SMT to the buy side here, you had an SMT to the buy side here, but then you had another one to the bear side, right? So essentially what I'm playing is another sort of retracement, another sort of sweep of stops, right? And so what's essentially happening here is, let's go back and let's say, Okay, well, we know that data highs and data lows are going to be targeted. This low is highly likely to be targeted, and I'm going to draw out these stops here just so you can see them. Right, and this also occurs right around 9:50, which is really your 10 a.m. ICT version of the silver bullet, which is not MMXM traders. Again, if you looked again, if you can scroll back into the video, this is the short entry I took right here at 39. Right, and I covered them right around here after we got this 1 minute market structure shift. Right, after I saw this kind of displacement, I got my structural invalidation that we were going to stop out. MSS, wrong one. MSS, right? Right. And so my original invalidation was this closing through this 1 minute SIBI here. And just for sake of simplicity, because I already have it drawn out, there's this SIBI, 1 minute SIBI, this 1 minute breaker that I like. So this is your classic unicorn setup. And so I was already deep in profits. So I took my profits here. I was like 50 points in profits off of 2 contracts. So that was, I took the trade there. But there was another opportunity to get short after that. And I'll show you right now here. You can see this 858 candle, this 930 candle, right? And let's talk about our news candle distributions in relation to 930, right? If 830 doesn't manipulate, expect 930 to manipulate, right? If 830 manipulates, expect 930 distribution to the other side, right? But this is in relation to the London protraction. Today, we had London accumulation below MOP that was delayed. We didn't have London manipulation. That is why 830 manipulated into the BISI, and that aligns with the protraction profile of continuation off of an hourly BISI. See how the concepts are blending? Using that information I just said, it is highly likely that 930 is going to continue downwards. And when I was saying at the beginning of this recording was that YM is also a valid cracking correlation to look at here. And if you pull it up right here, you can see this 855 or 858, YM actually takes that high while NASDAQ does not. That is another entry for shorts. You could have caught 120 points down into your 10 a.m. silver bullet. This is an example of a true S&D day, right? It's true seek and destroy day. You have SMTs on both sides of the market. You're still bullish on the week. We're at all-time highs. You kind of want to target your IPTA 20-day lows, but you got a 4-hour SISD. You need to trade alongside order flow. Recognizing these kinds of things, recognizing these SMTs, how we're respecting bullish PD arrays, how we're running stops, those are the things that are really going to play into helping you read order flow and helping you really sync. Right? And it's not going to be a sudden aha moment. It's just going to kind of happen over time. You really have to get those reps in and just keep showing up and keep putting in the work. And so you'll really start to get to see these kinds of things. And so let's go back to our hourly chart. So all things considered, if we're following our market maker model, you look for hourly and 5-minute continuation. Right? So this hourly BISI holds twice on 2 wicks, once here, twice here. If you're considering true continuation, you would have gotten long again at 1250, right? But because it's an S&D day, I don't want to play the classic models, even though that's safer, right? And that's what you should have done. What I did was I played high resistance shorts, and so I'll show you why right now. So all things considered, we're bullish on the day, right? Playing shorts, if you're playing any sort of shorts, number one, don't expect an SMT unless it's a lower time frame 1 minute market maker model, buy model, or 30-second into a 5 or a 15. And knowing they're going to be high resistance, you're better off playing longs. So seeing this H4 SIBI, I saw that NAS traded back into it. So I told myself, okay, I'm going to play this retracement. So what I did was here, I saw that we traded into the H4 BISI. I figured that the 50% of this dealing range, because we move, remember I was saying this at the beginning of the video, we move from discount to premium. If you look at this dealing range, it's right around the equilibrium point. So I dropped to the 5-minute instead of the 15 for this H4 SIBI. And I'm going to show you right now. I saw we had this market structure shift, which we barely got. And we had this SIBI, and we had a breaker right here. So 5 SIBI, H4 breaker block. All right, bang. All right, you could have taken that trade. You would have gotten a lot of points here. What is this? I entered here around like 14. I got out around like 40. That is like 60, 80 points on 2 contracts. It was a killer trade. You can scroll back to watch the entries for that again. But that was the retracement play. If you were looking to get long again and you were following all your hourly conditions, this is your M5 SIBI or your M5 BISI. And I actually targeted this devil's mark too. I forgot to mention that. There was this devil mark here, right? Think about your open, high, low, close concepts. Here is just open, high, close. There's no low being put in. There's no manipulation. There's orders there. That is liquidity. That is a highly likely draw. So you could have gotten long at this M5 BISI, or if you really wanted to, you could have waited for the secondary market structure shift here and gotten long again at this other M5 BISI. If you really wanted to, and then you could have gone to just trade it. I played the short retracement because I had to go ahead, other work to do. But basically, what I just want to tell you is that if you're in sync with order flow, you're putting in the work, and you kind of know what's going on in price. You're looking at the narrative over the PD arrays, right? And it's always remember this: time over liquidity for PD arrays. And I just want to rant about this for a second. If you can really get down the concept of what I'm saying about time, putting time first, considering the time of the week, considering what time news is, considering when the hourly candle is going to open, or the H4 candle is going to open, or when both of them are going to close. If you're looking for time frame alignment between your H1 and your H4 and your M5 and your M15, if you're truly in sync with time frame alignment, you will become in sync with order flow. You will get in sync with order flow. The moment I had that happen, I became in sync with order flow. And it's really not, I snapped my fingers, but it's really not a sort of aha moment. It happens over time. It happens over reps, right? The first thing I considered was, where is our ERL and our IRL? That's our liquidity. All the PD arrays in between, there's a lot of PD arrays. You can identify the important ones. You can find out which ones to get on, but that doesn't matter if you don't have time and you don't have liquidity. Focus on time, and these trades will start to become more clear. I know I didn't get a pre-news entry like the last trade, the last video that I posted, but I still caught a crap ton of points. I think even more than I did the other day, if you put the trades combined. But that was basically the trade recap for this week. All right, so one more time, these are the concepts that you need to know, and I hope that you learned something from this. Any questions, you can hit me up on Twitter or leave it in the comments.